Good morning, traders. Today is the 29th of August, moving into September on Wednesday of next week. This is your new TT scanner hot list. Let's get right into it. The Fed last week settled concerns with regards to tightening and any other changes that may come up, propelled a very strong rally in the markets. Traders and investors were waiting on the Fed Jackson Hole comments, and basically Jerome Powell came out and said that they are not willing to act until they're confident that they've bypassed any potential economic headwinds. That means that the Fed's going to continue to buy everything that they can in support of the market. Now, what that means is that we are going to continue to see market distortions. We're going to see the markets probably continue to rally, at least in the intermediate term. We're moving into the end of the year. If the Fed continues to keep buying through the Christmas rally season, we may see a fairly strong rally for the next 3 to 5 months. Although we're starting to see some concerns globally, and we're going to have to pay attention to that. Generally, as long as the Fed wants to keep being the lender of last resort and pump money into the markets, this trend will never end. The Fed is dumping $160 billion a month into assets, and when you break that down, that's about $2 billion a day, if am I correct, $2.5 billion a day into assets. That's a huge amount of money just to support the markets. So consumers, on the other hand, may get screwed. The eviction moratorium is ending. The foreclosure moratorium will end soon. We'll have to see what ends up happening here with regards to work and consumer spending. It may be that the Fed, is going to keep pushing this thing just as far as they can go, and we'll see if the markets react positively or negatively to that. Initially, it should be positive. So now, last week we had a number of bearish signals and bearish rotations. We're back about 2/3 bullish here. Couple of new triggers over here. Nothing on the bullish side. Couple of new bearish triggers. Very important to understand how the markets are rotating right now, and we'll get to that here in a moment. Let's scroll through these other images, which are older TT scanners. And now let's go ahead and take a look at the FANGs index. Rotated back up to the upside, extremely bullish, well outside of traditional range. We had seen this rotation here. This rotation here is like normal upper price range. Getting up into this area is fairly extended. Getting up above this channel here, this is extreme exuberance. This is really odd trending. Think of it as distortion. Very unlikely for the markets to continue to rally in this manner, but the Fed, with the Fed backstop the way it is, this distortion could continue. So again, we're seeing just a continued melt up here, may continue for quite a while. My advice is to stay bullish, but stay cautious. This thing could break ugly at any moment, just because consumers and everyone in their right mind knows that this is a distorted kind of a smoke and mirrors kind of market right now. But as long as the Fed is continuing to dump money into the market to try to support it, the path of least resistance is to go higher. As we move over here, the U.S. stock market index powered again to new highs. You can see we're getting this diminishing peak level on the RSI. My indication that we would have seen some sort of a topping formation here prior to the Fed activity kind of blew off. Now we're just melting higher again. Again, this is worth it for you to get involved on the long side. I would not urge you to fight the Fed. I'm still fairly cautious of a potential breakdown, something unraveling. Don't know what it would be right now with the Fed backstop. It could be foreign, could be China, could be wars, who knows? But again, ride this upward, my opinion, ride it upward, take advantage of it upward. The way I have the allocation set up, I'll show you in a minute, should do this quite well for us. But again, stay fairly cautious. This is not an organic rally. This is a smoke and mirrors rally prompted primarily by the Fed. The smart cash index, which is the global market index, is broken downward. As I mentioned last week, had a little bit of support last week. You can see that we're not seeing the same type of rally that we saw in the US stock market index. We've seen a deep, deep rotation here. We will, if you ignore the Fed and you take a look at global markets, this downward rotation is a search for fair value, market price fair value. And we may be nearing something fair, closer to fair value in the foreign markets, which means that we may start to see some sort of a momentum, a true organic momentum base take place. But this is really telling you here that the foreign markets are weakening, where the U.S. market is rallying, and that's primarily because the U.S. markets are the benefactor of the Fed. So again, we're seeing weakening foreign markets, strengthening U.S. markets. That's going to pile a lot of investors into the U.S. markets, but it's also going to create a lot of volatility and a lot of distortion. As we look over here at metals, metals are starting to form a real solid bottom here. Could be looking to break out before the end of the year and try to get back up into these highs. We've had a real solid triple bottom, as I mentioned to you. What we need to see is some follow through here. Could be a couple of months before we see the market start to move higher. Could be, if the dollar moves lower, could be that we see a move higher quite substantially over the next couple of months. Really need to pay attention to what the US dollar is going to do with this Fed backing, whether or not it's going to find support or whether or not it's going to break down. So we'll see how this plays out. And again, the Christmas rally here could change things if consumers are really going to participate this year. We'll see. I mean, ideally, like I said, throwing a bunch of supposedly 2.8 to 3.5 million people, renters, are going to get evicted. I'm noticing it out here. Moving trucks are all over the place out here in California. I'm assuming that there's a lot of people that are relocating and or about to be relocated. So it could be a very interesting Christmas. And so we need to just kind of see how it goes. It's moving kind of fluidly sideways, in my opinion. Which brings us to the valuations chart. Fluidly sideways. We're not seeing any real trending over the past 4 or 5 weeks. This indicates to me that the markets are not really organically moving. We're seeing likely a deleveraging event take place with the foreign markets moving lower, the U.S. markets moving higher. The treasury yields have kind of flattened back out. The dollars move lower. My opinion is we're seeing kind of a flattening. So hypothetically, as the U.S. markets move higher, people are pulling trades away from the market, deleveraging, getting rid of risk, pulling profits, and that's very, very likely to continue over the next couple of months as we move into the end of the year. Remember, there's a lot of really interesting dynamics. Afghanistan, political, spending bills, evictions, foreclosures. I mean, I could just go on and on and on. It seems like there's all kinds of stuff that's going on that could disrupt the market. And again, any type of credit risk or debt risk that occurs going forward could be very, very interesting for the market. So in preparation for this, what's likely to happen is institutional traders and more skilled traders are going to start pulling risk capital away from risk. They're going to start deleveraging. They're going to start pulling profits. They're going to start getting into cash. And that is something that's very, very important going forward. Okay, the commodity index, and this is again a great example of the hyperinflation that occurred after COVID. We saw a big rotation. This is when Bitcoin and AMC and the Reddit group piled huge allocations into stocks and really kind of blew off a bubble. Then commodities followed about 2 months, 3 months later. This is a huge rotation at the end of, you see here, this is COVID. This is the reflation trade out of COVID. This is a scenario where we get this rotation in the market back to the downside, kind of a end of year prior to the election consolidation. This was the election. And now we start to see this real rally take place. This was an excess rally that blew off and has now started to consolidate. Down here near these lows where we're at right here, we could see a bit of a bit of reflation. We could see it move back up to 6, 7, maybe even 8 or higher. which would be a bit of a reflation trade, especially with the Fed providing a backstop going forward. But long and short of it, ladies and gentlemen, is we're kind of in a very fluid market. So my advice again would be to stay cautious, stay bullish. Right now, there's no reason to think that anything's going to break to the downside, but understand that we're in a very weird market, and I just want to warn you that things could happen very quickly. It's kind of like the straw that broke the camel's back. It's not the one or two straws, the weight of the one or two straws. It's the enormity of the entire weight of all the straws on the back of the camel. At this particular point, this blow off, this huge rotation that's going ahead and been rotated around really shows an excess phase blow off has taken place. So at this point, with the U.S. markets so high, the foreign markets moving lower, commodities moving lower, consumers pulling away, traders starting to pull capital away from these excessive price highs, we're in a very interesting dynamic. It's almost like the floor is being pulled out from the bottom of the market, and we could see some risk setting up. So I just want to warn you that my interpretation here is the train is still moving upward, the trend is still bullish, but it looks to me like the engine's starting to kind of blow apart. And we'll see if something actually, if it stays together long enough for us to get there, or whether something happens over the next couple of months to blow it apart. So I think that's the end of things here. Oh, wait, the volatility index, again, back into new highs, back above this pink line again. Very strong market trending at this point. And as I mentioned to you, these levels are just really extreme. We could see higher trending. This is a big rally phase. Remember the chart that I showed you back here? Um, I think it was this one. Nope, it was this one. So this is really a good example. So this is the valuations chart, or sorry, the commodity gold index. This is normal rotation through normal trending. Fed was still active here, but not super active. COVID blew everything apart. We had the reflation trade. We had the consolidation and trending before the election. This is indecision taking place. Everything just kind of falls to a flat line. This was the post-election rally. We start getting into the COVID the Reddit move where Bitcoin and AMC and others rallied. Now we see the commodity price inflation and the commodity devaluation. Now we're kind of getting back into that uncertainty, which is likely going to cause it to move back down into these lower areas and attempting to form some sort of new reflation. New reflation would have to take place from potentially the Fed, or potentially organically seeing the markets really enter a profit phase, a new price appreciation phase. And that may not come until it moves quite a bit lower. So now let's take a look back over here at the volatility index. You see COVID. This is normal price activity prior to COVID. You see COVID blowing out. You see the rotation here. You see the consolidation prior to the election. You see the election rotation here. This is the early Reddit move again. Then we see the post-Reddit move, which this is the inflation of commodities and the Fed, the real rally phase in the U.S. market prompted by the Fed and commodities and hyper speculation. At this point, we're back into still in hyper speculation with the U.S. stock market. We're up above these extreme levels here. We're struggling to get back above this. We could continue to flag out here with more bullish trending. Remember, it stays above 10, 11, 12. That's bullish trending. It's really, just consolidating. Easiest pathway is to move forward, but it is consolidating in an upward trend. But again, these are extreme levels. This is extreme speculation with volatility, huge volatility in the market, which is again why, again, I told you, the trend is easy. It's easiest to move up right now, but there's a lot of risk in the market right now because of these Fed distortions. And this is the older TT scanner. Now let me come back over here and take a look at these. These are the new gauges. And I'm writing here, the U.S. Fed settled the markets and prompted a new bullish rally that may last many weeks. I urge members to consider the markets are extremely distorted because the U.S. Fed because of the U.S. Fed. The Fed's actions are prompting hyper speculation. The volatility, leverage, and risk are extremely high in these markets as well. Stay protected and ride this rally for what it is worth. Remember, bubbles burst at some time in the future, and this is no different. This is an extreme bubble, and they burst for various reasons. But at this point, right now, ladies and gentlemen, this is an extreme bubble. Ride it for what it's worth, and let's just stay cautious as we move forward. Metals should begin to move higher. Bonds are already starting to move a bit higher. Keeping a cash position is critical in case something does blow up. And trading stocks, 25 to 35% of your portfolio is very good right now. I do not recommend getting overweighted stocks versus bonds, metals, and cash, simply because when things break, they will break in a very ugly format. So right now, if we go back the other direction, the trending on the TT rotational, the MENT rotational modeling system hasn't changed over the last couple of weeks, and that's what we're going to get to next. The MENT rotational modeling system for the SPY is still bullish after last week. Nothing has changed. For the S&P 500, the E-mini, bullish weekly, bullish daily. For the NASDAQ, bullish weekly, bullish daily. Nothing has really changed, ladies and gentlemen. Gold is bullish weekly, bearish daily, showing some real strength. This is because the dollar collapsed, and we're likely to see some upward movement in metals. As I mentioned to you, we're above 1800 again. We could get back up above these 1900 levels and really try for 21, 2200 before the end of the year. Silver taking its sweet time and trying to move forward, but still bullish weekly, bearish daily. Very likely to try to move back up to this $27, $28 area over the next 3 to 4 weeks. Crude oil's been moving higher after a fairly deep rotation. It is bullish weekly, bullish daily, even though it's pinkish, it's still bullish. We're likely to see some consolidation here. We really need to see consumer participation and economic revision, meaning economy to still continue to move and grow, which I have my doubts about. I'll talk about that before the end of this video. The Dow Jones Industrial Average, bullish weekly, bullish daily, had a big recovery last week in the Dow Jones Industrial Average with the Fed comments. We really need to see how this plays out. Transportation index was up fairly strong on Friday. We are still bullish weekly, bullish daily. You can see it is flagging out here. We need to get above these highs if we're going to see some new upward trending. That's 15,000 on the daily chart. The transportation index is one of those indexes that leads the market. So this sideways flagging could be leading into the end of the year, more than likely. And I'll show you here this rotation. If you take a look here, and I'll try to draw it for you. More than likely, this rotation is related to what I believe has happened with regard to COVID and where we're going to see a reversion in trending. So hypothetically, the market's been rolling around in this kind of a trending mode, and then COVID hit and distorted the market lows. This was a disruption in the market that distorted all of the economic data based on these extreme lows. Everything collapsed, everything went into negatives, consumers pulled away, everything collapsed. Now we've seen this reflation trade back to the upside, which is essentially a big ripple. Think of this as a big rock that hit the nice smooth lake water and created this big depression in the lake. Now the next phase is a big rally phase, the huge upward wave that takes place. The next phase should be a downward phase that settles somewhere down in here and begins to level off. So essentially we're looking at this huge reflation wave that's taken place. The next phase is a downward cycle wave, which is a reversion or a dampening sine wave structure. And this is where I believe the market trends are going to happen. And this is why the Fed is being very cautious. I think they know this next downward wave is taking place. That's why they're not acting in any manner to ease weakening policy. I think they're prepared for it. So we take a look here at the IWM, which is the Russell 2000. Bullish weekly, bullish daily, big rally here. Could stall out over the next couple of weeks. We'll see. Financial sector, bullish weekly, bullish daily, and looks like everything's pretty much moving forward. Now, let me come over here, try to find that reflation cycle. I may not have it here. I do not see it in this list. Let me try to find it real quick. And here, and here, and not here. Here we go. Okay, ladies and gentlemen, this is what I was explaining to you. Flat lake level, think of the economy just moving around in normal ranges, then COVID hit, disrupted the amplitude of economic cycles and economic indicators. We had this huge, massive disruption. Consumers pulled away. Everything collapsed. Now, the reflation cycle that comes after this is where we are right now. And we're probably very near or just past this peak right over here, which means we're now going to start to move into a downside deflationary move. And year over year, once we get down into this area, month over month and year over year, as this moves higher and we start progressing down over here, we're going to start to see year over year negative values, probably towards the November, December, January, February timeframe, meaning end of this year, early 2020. All of the economic data is going to start pointing to extreme negatives. And that's because year over year, we've had this massive inflation. And if you compare this point to this point, it's going to look month over month and year over year pretty damn ugly, which is why I believe the Fed is doing what they're doing. They're keeping everything super easy. They want to get us out past this rotational model and hopefully not see anything come into play. Now, if we are up here, I want you to understand, if we are up here and we get some sort of a new disruption event, new COVID event, new war, new something that disrupts the markets, this amplitude level suggests that an even bigger, deeper downside move could take place if the disruption event is massive. So understand that as long as we do not see any new disruptive event, we should continue to move in this manner, flattening out economic data and moving back towards a transitionary upward, or let's call it more organic market trend. Over the next 8 months, I think we're going to see some pretty ugly numbers come out. And I think we could be a little bit shocked about what the economy is doing, what GDP is doing, what we're really seeing. And this could mean that the consumer pulls away quite extensively. But we're not here yet. We're still back up here in this inflation. Year over year data is like, wow, everything's going great. Nobody worries about anything until we start to get over here to this point where year over year, wow, what happened? We were doing so well. Now the economy is contracting. It's just a matter of measurement of the waves. So when we get into these big, destructive, distorted waves, things look different. But in reality, if you average this out, you would see that we're pretty much seeing a moderate upswing. These are reflation cycle, normalization cycle, reflation cycle, normalization cycle, reflation cycle, normalization cycle, and then eventually we'll flatten back out into this area. Okay, that's my update. A little long today. Remember, we're looking for the markets to continue to trend upward until some disruptive event takes place. Let's hope it doesn't happen over the next 20 or 30 days. In the meantime, stay properly protected. Gold, silver, bonds, and cash. You want to have a nice balance in the markets right now. Don't get overly weighted anything because volatility and risk are still quite elevated. This is not your friendly market from 2016, 17, 18. This is a very distorted, very ugly, raging beast of a market that could turn on you and really become very ugly. All right, that's it for now.